GameStop. 2021. Retail investors bought shares and crashed a hedge fund. Wall Street called it dangerous, said ordinary people shouldn't be allowed to buy stocks freely. Too risky. Brokerages restricted trading. Congress held hearings. Financial media called it market manipulation. But retail investors were just buying shares, legally, on public exchanges, doing exactly what the system claims to allow. The hedge fund was short-selling. Betting GameStop would fail. When retail investors bought instead, the hedge fund lost billions. Their strategy failed, so the system protected them and punished the retail investors. Rome solved this problem 2,000 years ago. They created a stock market where any citizen could buy shares, vote on management, collect dividends, fire corrupt executives. It worked for 400 years. Then we forgot how they did it, and we built Wall Street instead. A system where 90% of shares are owned by 10% of people, where corporate boards answer to hedge funds, not shareholders, where transparency is optional. I'm going to show you exactly how Rome's stock market worked, using legal documents, Cicero's personal letters, and modern economic analysis. The evidence is undeniable. Rome's system was more democratic than ours, and we can prove it. Let's start with something that will shock you. Rome had publicly traded corporations in 100 BC. Not trading posts, not partnerships, actual corporations with shares that anyone could buy and sell. They called them societas, publicanorum, public societies. These were companies that bid on government contracts, tax collection, mining operations, infrastructure projects, anything the Roman state needed done but didn't want to do itself. The contracts were awarded through competitive bidding. Companies proposed their terms. The Senate voted on which company won. Transparent process. Public voting. Documented results, all recorded in official records that survived. Here's where it gets interesting. To raise capital, these companies issued shares, called partas. Any Roman citizen could buy them. There was no minimum investment, no accredited investor requirement, no wealth threshold. You wanted to own part of a tax collection company. You bought shares in the forum. Literally. There was a section of the Roman Forum where stockbrokers gathered. They matched buyers and sellers every single day. The shares were transferable, meaning you could sell them whenever you wanted. You didn't need permission from the company. You didn't need to hold for a minimum period. Free market. Pure liquidity. Cicero documented this in his letters. He owned shares in multiple companies. He wrote to his friend Atticus about buying and selling them, discussing dividend payments, complaining about management decisions. Sound familiar? His letters weren't meant for publication. They were private correspondence, which makes them more valuable as evidence. He wasn't trying to impress anyone. He was managing his investments, just like modern investors. Here's a direct quote from Cicero's letter in 54 BC. I've been buying shares in the Asian tax companies. The management is questionable, but the returns are solid. He's literally describing stock picking. 2,000 years ago. Another letter mentions selling shares before bad news became public. He knew a tax contract was failing. Sold his shares early, avoided losses, inside information. Cicero was insider trading, and documenting it in writing. The companies paid quarterly dividends, not annually, quarterly. They calculated profits every 3 months and distributed a percentage to shareholders. The rate varied by company and contract performance, market-based returns. The dividend payments were documented in company records. Shareholders received notification tablets. The amount, the calculation, the payment date, everything recorded, transparent, predictable. Investors could plan around quarterly income. Dividend yields ranged from 5% to 25% annually depending on the contract. Tax collection companies paid higher dividends but had more risk. Infrastructure companies paid lower but steadier dividends. Risk-return trade-off. Portfolio theory in practice. Shareholders had voting rights. This is critical. If you own shares, you voted on major decisions. New contracts. Management appointments, profit distribution, one share, one vote, democratic corporate governance. And here's the part that should make modern investors jealous. Shareholders could remove executives. If a manager was incompetent or corrupt, shareholders voted them out. No golden parachutes, no board protection, accountability. The companies were required to publish accounts publicly. They posted financial statements in the forum. Revenue, expenses, profits, losses, anyone could examine them. Complete transparency. By law. Compare this to modern corporations. How many shareholders actually vote? How many can remove a CEO? How many get to see detailed financial data before earnings calls? Rome had better disclosure 2,000 years ago. Now, let me show you the evidence that proves this wasn't just for elites. This was genuinely accessible to ordinary citizens. The sources are academic, verified, and documented. Professor Ulrike Malmendier at UC Berkeley analysed Roman legal documents and financial records. Her research paper, Roman Shares, is published by the National Bureau of Economic Research. I've linked it in the description. Malmendier found evidence of small shareholders owning fractions of shares, people pooling money to buy partial ownership. This means even poor Romans could invest. They created informal investment clubs. Crowdfunding. 2,000 years before Kickstarter. The evidence comes from legal cases, disputes over share ownership, inheritance of shares, fraud cases, all documented in Roman law. These weren't theoretical. These were actual court cases involving real people and real money. One case from 70 BC involves a freedman, a former slave. He owned shares in a mining company. When he died, his son inherited them. The son sued the company for unpaid dividends. He won. The court records survived. The court ruled that shares were property, inheritable, legally protected. The company had to pay the back dividends plus interest, legal precedent, shareholder rights enforced by law. Think about that. A former slave, owning shares, passing them to his children, getting legal protection for his investment. This wasn't just for senators. This was economic mobility through capital markets. In modern America, 40% of adults own no stocks at all, not even through retirement accounts. They're completely excluded from capital markets. Rome's system was more inclusive 2,000 years ago. The Cambridge Ancient History documents the scale. By 50 BC, there were dozens of these companies operating across the empire, employing tens of thousands, with thousands of shareholders, a functioning stock market. Here's how the trading actually worked. You went to the forum, found a broker called an argentarius. He kept a ledger of buyers and sellers. You stated your price. He matched you with a counterparty. The transaction was recorded on wax tablets, witnessed, signed, then transferred to permanent records. The company updated its shareholder register. You received documentation proving ownership, paper trail, legal protection. The broker took a commission, usually 1 to 2%. Competitive market. Multiple brokers meant competitive pricing. If one broker charged too much, you used another. Free market dynamics. Share prices fluctuated based on company performance and contract expectations. When a company won a lucrative tax contract, share prices rose. When contracts ended poorly, prices fell. Market pricing, supply and demand. Price discovery happened daily in the forum. Buyers and sellers negotiating, brokers facilitating, information spreading through the marketplace. News about contracts affected prices immediately. Efficient market hypothesis in practice, 2,000 years before Eugene Farmer formalized it. Investors watched contract auctions closely. When a company won a major 5-year tax contract, buying pressure increased. Share prices jumped 10 to 20% in days. When contracts failed to renew, selling pressures spiked. Prices dropped accordingly. Information was quickly incorporated into market prices. There's documented evidence of speculation. People buying shares hoping to sell at higher prices. Short-term traders. Long-term investors. Market psychology. Cicero complained about it, called speculators reckless. The debate over speculation is 2,000 years old. Companies competed for investors. They advertised their contracts, highlighted their management experience, published past performance, investor relations, marketing to shareholders, corporate competition for capital. Hostile takeovers happened. A group of investors would buy majority shares in a poorly managed company. Vote out the executives, install new management, improve performance, sell at profit. Corporate raiders. In 100 BC. The earliest documented case happened in 90 BC. A consortium of investors bought 51% of a struggling tax company, fired the entire management team, brought in new leadership. The company became profitable within 2 years. The previous executives sued, claimed the takeover was illegal. The courts ruled against them. Shareholders have the right to change management. That's what ownership means. Legal precedent established. Hostile takeovers were legitimate. The system had problems. Of course it did. Corruption existed. Some tax collectors abused their power. Some companies cooked the books. Fraud happened. But the system had legal remedies, courts, penalties, enforcement. What's interesting is the transparency requirement. Because financial statements were public, fraud was harder. Any citizen could examine the accounts, question discrepancies, file lawsuits, crowdsourced oversight. Modern corporations hide behind complexity. Earnings reports are hundreds of pages, footnotes, obscure liabilities. Special purpose entities shift debt off books. Roman companies couldn't do this. Their accounts were simple. Revenue minus expenses equals profit. That's it. Here's where it gets dangerous today. We've lost this democratic access. In 1900, individual investors own 90% of US stocks. By 2020, institutional investors own 90%. Complete reversal. Pension funds, mutual funds, hedge funds, index funds, insurance companies. These institutions own almost everything. Individual investors are minority participants in a market supposedly designed for them. The average person can't compete with algorithmic trading, can't access the same information as hedge funds, can't influence corporate decisions. Modern markets favour institutions over individuals. Rome's system favoured participation. During the GameStop situation, retail investors organised, bought shares collectively, forced hedge funds to cover short positions. Wall Street's response? Restrict trading, protect institutions, exactly what Rome prevented through democratic access. Robinhood literally stopped people from buying GameStop shares, claimed it was for market stability. Translation: retail investors were winning, institutions were losing, so they changed the rules. Rome's system didn't allow this. In Rome, if you owned shares, you could vote. Period. Modern corporations have dual-class shares. Founder shares with 10 votes. Public shares with 1 vote. Some public shares have 0 votes. Voting rights separated from ownership. Mark Zuckerberg owns 14% of Meta, but controls 58% of voting power, because he has super voting shares. Public shareholders have money invested but no control. Rome would have called this tyranny. The Roman system required 1 share, 1 vote. You couldn't separate ownership from control. If you owned 10% of shares, you had 10% of votes. Proportional, democratic, fair. Modern shareholders can't remove executives easily. CEO pay is determined by boards. The CEO effectively controls. Even when companies perform poorly, executives get massive severance. Rome's shareholders could fire managers immediately. When a Roman company failed to meet contract obligations, shareholders voted to replace leadership. No waiting for annual meetings. No proxy fights. Immediate accountability. The manager was out, new leadership in, performance mattered. Here's the comparison that should concern you. Rome's stock market existed to serve the public good. Companies bid on government contracts, built infrastructure, collected taxes, provided services. Profit motive aligned with public benefit. Modern corporations exist to maximize shareholder value. But which shareholders? The hedge fund that owns for 3 months? The index fund that never sells? The retail investor who actually uses the product? Conflicting interests. Rome avoided this by making contracts short-term. Tax collection contracts lasted 5 years maximum. Then companies rebid. If they performed poorly, they lost the contract. If they performed well, they won renewal. Performance accountability. Modern corporations are perpetual. CEOs can run them into the ground for decades. Shareholders can't force dissolution, can't demand new leadership without extraordinary effort. The company continues regardless of performance. Rome's system forced regular evaluation. The evidence shows Rome's market had boom-bust cycles. When the empire expanded, tax contracts became lucrative. Share prices soared. Everyone invested. Then expansion stopped. Contracts became less profitable. Prices crashed. Classic bubble. The biggest crash happened during the civil wars. When Caesar crossed the Rubicon in 49 BC, the stock market collapsed. Political instability meant contract uncertainty. Share prices fell 90%. Investors lost fortunes. Wealthy Romans saw their portfolios disappear overnight. Middle-class investors lost their savings. The panic was empire-wide. People tried to sell. Nobody was buying. Classic market freeze. Liquidity crisis. But the market survived. After Augustus established the empire, stability returned. Share prices recovered. New companies formed. The market continued for another 300 years. Resilience through structure. The recovery took time. 5 years before prices returned to pre-war levels. But they did recover, because the underlying system remained sound. Political stability restored confidence. Capital markets resumed functioning. What killed Rome's stock market wasn't internal failure, it was government takeover. As the empire centralized power, emperors nationalized tax collection, eliminated private contracts. No contracts meant no companies. No companies meant no shares. By 200 AD, the societas publicanorum were mostly gone. The government collected its own taxes, built its own infrastructure, employed its own workers. The stock market disappeared because the government eliminated the market. This is the historical irony. Rome's stock market died from government expansion. Modern stock markets exist because governments created them. Different causes, same result. Government decides whether markets exist. So what should you take from this? 3 things. First, democratic corporate governance is possible. Rome proved it. 1 share, 1 vote. Transparent accounting. Shareholder power to remove management. We chose a different system. Second, market access matters more than market sophistication. Rome's system was simple, but any citizen could participate. Modern markets are complex. Most citizens can't effectively participate. Complexity favors insiders over outsiders. Third, the purpose of corporations matters. Rome's companies served public contracts. Modern corporations serve shareholders. But which shareholders? Short-term traders or long-term owners? Institutions or individuals? Purpose shapes behavior. The Roman system wasn't perfect. Corruption existed, speculation caused problems, market crashes hurt people. But the system had structural advantages we've lost: transparency, accountability, democratic participation. Malmendier's research shows that Roman share prices correlated with economic fundamentals. When tax revenues were good, share prices rose. When revenues fell, prices fell. Market prices reflected reality, not speculation bubbles. Modern stock prices often disconnect from fundamentals. Companies with no profits trade at massive valuations. Meme stocks surge on social media hype. Algorithmic trading creates flash crashes. Prices reflect sentiment more than economics. Rome's requirement for public financial statements prevented some of this. When everyone could see the actual revenues and expenses, pure speculation was harder. The fundamentals were public. The math was simple. Harder to hype. Between 100 BC and 200 AD, the societas publicanorum provided capital for infrastructure across the empire. Roads, aqueducts, ports, mining, tax collection, private capital funding, public goods. The model worked. Modern infrastructure relies on government bonds or public-private partnerships with guaranteed returns. Less risk for investors, but also less accountability. Rome's model forced companies to compete for contracts. Performance determined profit. Some Roman companies made enormous returns, 20 to 30% annually on successful tax contracts. But they also risked total loss if contracts failed. High risk, high reward. Investors knew this. They diversified. Cicero's letters mention owning shares in 6 different companies. Diversification, risk management, portfolio theory. 2,000 years before Harry Markowitz formalized it. Investors learned through experience what academics later proved mathematically. The most successful investors in Rome were those who studied the contracts, understood the regions, analyzed past performance. Fundamental analysis, value investing, Benjamin Graham's principles applied in ancient Rome. The strategies are timeless. There's documented evidence of insider trading. Senators who knew about upcoming contracts in advance bought shares early. Sold before bad news became public. Same problem as today, information asymmetry creates unfair advantage. Rome tried to prevent this through disclosure laws, required public posting of all government contracts before bidding, mandated public financial statements after winning. The laws helped, but enforcement was inconsistent. Familiar problem. Modern insider trading laws are stricter, but enforcement is still inconsistent. High-profile cases get prosecuted. Most insider trading goes unpunished. Rome had the same challenge. Laws exist. Enforcement determines effectiveness. What's different is the complexity. Roman insider trading was simple. A senator learned about a contract, bought shares. Contract announced. Shares rose. He sold. Easy to identify. Modern insider trading hides in derivatives and offshore accounts. The Roman Empire eventually collapsed. The stock market disappeared with it. For over 1,000 years, Europe had no corporate shares, no public markets. The concept was lost, only rediscovered in the 1600s. During the Dark Ages and Middle Ages, people forgot Rome even had stock markets. The knowledge disappeared. Medieval Europe had partnerships and guilds, but no publicly traded shares. The concept was gone. The Dutch East India Company issued shares in 1602, called it innovation. But Rome had done it 1,700 years earlier. We didn't invent stock markets, we rediscovered them. And we added complexity. Rome avoided. The Dutch claimed they invented the joint stock company. Historians celebrated it as a breakthrough. Nobody remembered Rome had already solved this problem. Historical amnesia. We reinvented what we forgot. Rome's shares were simple. Ownership percentage, voting rights, dividend claims, that's it. Modern shares come in dozens of varieties. Common, preferred, voting, non-voting, Class A, Class B. Complexity that benefits issuers over buyers. The simplicity of Rome's system had advantages. Anyone could understand it. You own shares. You get dividends. You vote on decisions. Clear. Modern securities require lawyers to interpret. Complexity obscures. Simplicity illuminates. So what happens next? Modern markets are consolidating. Institutional ownership increasing, individual participation decreasing. We're moving away from Rome's democratic model toward concentrated ownership, history going backward. Some platforms are trying to reverse this. Fractional shares, commission-free trading, accessible investing. Attempting to recreate democratic access Rome had. But algorithmic trading and institutional advantages remain. Systemic barriers. The question isn't whether stock markets should exist, it's what kind of stock market serves society best. Rome's model prioritized access, transparency and accountability. Wall Street prioritizes liquidity, efficiency and profit. Different values, different outcomes. Rome proved that democratic corporate governance works. For 400 years, any citizen could participate. Own shares, vote on management, collect profits. Then we built a system where most people can't effectively participate. All sources are linked in the description. The legal documents are preserved. Cicero's letters exist. Economic analysis is published. The evidence is accessible. Rome had a stock market, and in crucial ways it worked better than ours. The archaeological record is clear. The legal precedents are documented. The economic analysis is peer-reviewed. This isn't speculation. This isn't theory. This is verified historical fact. Rome created democratic corporate governance. We abandoned it. If this changed how you think about modern markets, subscribe. Because next video, I'm breaking down how Rome's banking crisis of 33 AD nearly collapsed the empire. The same credit crunch mechanisms as 2008. Same pattern, same mathematics. Banking panics, credit freezes, government bailouts, asset price collapses. Rome experienced all of it. In 33 AD, the emperor had to intervene. Sound familiar? The pattern repeats because the mathematics don't change. History's patterns decoded through evidence. That's what we do here. You now understand how Rome's stock market gave ordinary citizens power, Wall Street reserves for institutions. The system existed. We abandoned it. That's a choice we can revisit. The question isn't whether democratic markets are possible. Rome proved they are. The question is whether we want them. Because the choice is ours. Every generation chooses its economic system. We